Is the current AI bubble worse than the dot-com bubble? The answer is yes. I'm going to reveal why, and probably more importantly, what you can do to protect yourself and your portfolio in 3 simple, fast steps. Step number 1, let's go over not just the insanity, the AI insanity. You like that? See what I did there? All right. So I know a lot of people get confused when they think about Nvidia or OpenAI or what's going on with CoreWeave, and they're just like, yeah, I get it, but it can't be as big of a bubble as the dot-com because these companies are actually making revenue. But I think the average Joe and Jane retail investor out there aren't really connecting the dots. Let me show you what I'm referring to. So this is not the average Joe. No. But it is the average Joe's son. That's right, Joe Jr. right here. And his future is so bright that he's got to wear shades. Why, you may be asking? Because he just graduated from high school, and look at this report card. All A+. So now he is on his way to college. We'll call it at AI University. And he's going to go to college and major in something like engineering, where he's very, very confident that once he gets out of AI University, he's going to have a job making $100,000 a year. Well, this is fantastic, you say. But there is a problem. You see, AI University is going to charge Joe Jr. $1 billion for tuition to get that degree that he needs to get the engineering job that is paying him $100,000. So do you think this is a good deal? The answer is obviously no. There's zero chance that Joe Jr. can pay back this $1 billion over the span of the next, let's just say, 30 years of him working his job, making $100,000 a year. The math doesn't work. And this is the exact same math when you look at these huge AI companies like Nvidia and OpenAI. Let me show you what I'm referring to. Right now, OpenAI, the head guy over there is Sam Altman. And he says that in the very near future, let's say over the next 2 or 3 years, they need to spend trillions of dollars on infrastructure. Trillions of dollars on infrastructure. And you may say to yourself, okay, well, that makes a lot of sense. I mean, AI is the future. And before we move on, I want to be very clear. Nobody is disputing that. AI is definitely the future, just like the internet was the future in the 1990s. But it doesn't necessarily mean we're not in a bubble when you look at the prices of these huge mega companies that might turn into micro companies. All right, so you think to yourself, okay, well, this is great, they're spending trillions, but then you got to scratch your head and say, well, wait a minute, where are they getting the trillions? And I think a lot of the retail investors out there would just assume that because everyone uses ChatGPT, well, they've got to be making trillions of dollars. Well, you would be wrong. Right now, their annual revenue, about $12 billion. Now, Harris Cooperman, who's a very famous hedge fund manager, most people just call him Cuppy, did a lot of research on this specific topic. And by his calculations, the industry as a whole needs to spend around $500 billion per year. Now, I think this trillions that Sam Altman threw out there, I think he may have been just trying to pump Nvidia's share price. More on that in just a moment. But by his calculation, Cuppy's, the industry as a whole needs to spend around $500 billion per year in buying all of this infrastructure. But the big problem there is the infrastructure is almost obsolete over the span of 2 years. So every other year, you've got to do all this CapEx spending just to keep up with the Joneses, so to speak, and just to deliver that product that you're charging $20 a month for. And his calculation, based on the industry and aggregate total, is that the revenues right now are around $15 to $20 billion. Well, think about that. $500 billion a year in expenses, but $20 billion a year in revenue. And by the way, that's just the CapEx spending. That doesn't include all the other expenses that go into delivering that service. So let's just write it on the board to make sure everyone's on the same page. So outlays of, let's say, 500 billion per year, but revenues of 20. Well, we have a technical saying in the finance business, that dog don't hunt. And you can see how this is very similar to the analogy that we used earlier, where Joe Jr., sure, he's getting a great job where his future is so bright, he's got to wear shades. That job, in other words, his revenue, is going to be $100,000 a year, but he owes $1 billion. So let's just break that down over the next 20 years and assume that he has to pay $50 million a year just to earn the $100,000. Okay, now let's introduce everyone's favorite whiteboard character right here, Moody the millennial. That's right, with their blue hair. There, because I don't know the preferred pronouns. So Moody has been listening to Dave Ramsey. Oh boy. And they have a little bit of extra money every single month. They've been working a couple different side hustles in addition to their job at Starbucks. So Moody, let's just say, has an extra $100 per month that they want to invest because they want to do the smart thing. So what Moody does, oh my gosh, AI is definitely the future. So Moody, and again, Moody is a representation for the aggregate total, the retail investor in the United States. They look at AI University and they say, whoa, this business is en fuego. They have assets of $1 billion. Holy cow. I'm going to go ahead and buy shares of AI University. So AI University issues all these shares, and let's say their market valuation goes up to $20 billion because they have this $1 billion of assets on their balance sheet. Right. But that $1 billion is basically an IOU from Joe Jr. that's only going to make $100,000 a year. So how good is that $1 billion asset on their balance sheet? Now, if you guys haven't guessed, AI University is simply Nvidia, and Joe Jr. is OpenAI. So we look at Nvidia with a $4 trillion market cap. And are they making money? Oh, absolutely they are. They definitely have revenue. They definitely have assets on their balance sheet. But then you have to step back and say, okay, well, in the future, are all of their customers going to be able to pay them enough money to warrant that, let's just say, $4 trillion valuation? And the answer is most likely, in fact, 99% most likely, no. So let's take this one step further, because it is true right now, the industry as a total making $20 billion. So you might say to yourself, okay, George, well, if AI is the future, well, maybe in 5 years, they're going to be making $10 trillion every single year, and therefore they're going to be able to afford to spend $1 trillion buying all this stuff from Nvidia, or paying back that $1 billion to AI University, whichever way you want to look at it. But here's the problem. It is true that AI adoption is going to grow exponentially. There's no one disputing that. But there isn't really a competitive moat around any one of these businesses. In other words, AI, just simply a commodity. I mean, for most of you out there, I'm sure you kind of use ChatGPT a little bit like a search engine. But what's preventing you from just going over and using Gemini or using Claude if they offered maybe a $10 a month program as opposed to a $20 a month premium subscription? The answer is not much. Most people would just say, okay, I'll just go over to Google and ask Google Gemini the exact same questions I was asking ChatGPT because they're giving me a little bit better price. You see, AI, especially in its current form, is basically a commodity. And with the commodity, there's only one way that you can outcompete your competitors, and that's on price. So we could see a world where in the future, the prices go down further and further and further and further, which means even though you have exponential growth in the adoption of AI, the actual revenues go from 12 billion down to who knows, maybe almost nothing. So right now the marketplace, or Moody the Millennial, is just focused on this right here. You've got OpenAI, and their future is so bright they got to wear shades. And then we have AI University, who is benefiting from OpenAI to the tune of $1 billion, which is making their share price, or their market cap, go up to $4 trillion. So Moody's just focusing on this. But Moody hasn't yet thought about this. So this is the whole key. When is the marketplace going to open up their eyes and be like, wait a minute here, this math doesn't work? I call it the Biden moment. And the reason I call it that is because remember back in 2024, when everyone in the mainstream media was trying to tell you that Joe Biden was as sharp as a tack. And anyone that would say anything different, well, they're just conspiracy theorists. But then what happened is you had the big night, the big debate between Donald Trump and Joe Biden, when it became crystal clear to everyone, including the people in the mainstream media that were backing Joe Biden, that, oh, wait a minute, nope, he's definitely not at 100% mentally, and therefore we got to get him out of here and throw in Kamala. If it wasn't for that big debate that was on TV and everybody saw that no one could dispute and come to a different conclusion other than Biden was losing it, that was the Biden moment. So at some point in time, we're most likely going to have an AI moment, if you will, but nobody can determine when. That's the problem. So could these stocks go higher and higher and higher and higher over the next year, the next 2 years? Could they double? Could they triple? Could they quadruple? Absolutely. We saw the exact same thing play out in the late 1990s. But the question is not, can the price go higher? The question is, does the risk reward make sense right now? And the answer is obviously no. Oh, but wait, there is more. My claim is that the current AI bubble is even worse than the dot-com bubble, and what we've described here is pretty much telling you why it's similar. So now what we're going to do is go into why I think it's even worse. And then at the end of this video, I'm going to tell you how you, the average Joe and Jane retail investor, can not only protect your wealth, but actually grow your wealth in these crazy financial markets of bulls, bears, and definitely bubbles. Step number 2. Now let's go over how Nvidia specifically impacts the S&P 500, therefore most people's 401k, most people's investment portfolio, and the U.S. economy. We're going to start by going over to an article from Yahoo Finance. Actually, this was written by Fortune magazine. Nvidia alone accounts for more than a third of the S&P's gains this year. And this was as of June 15th. So it may have changed slightly, but the concept is still the same. And for most retail investors out there, I don't think they really understand how a weighted index actually works. So what happens if you're just passively investing and doing the quote-unquote smart thing, according to Dave Ramsey, is you're just taking a percentage of your paycheck every single month and you're allocating that to a very inexpensive S&P index fund. So for every dollar that comes into that fund, it doesn't go out to every single one of those 500 companies equally. A greater percentage goes to the companies with the biggest market cap. So who do you think is the biggest beneficiary of this? Well, that would be Nvidia or AI university. So what happens is they're about 8 or 9% right now of the S&P 500. So for every dollar that goes in to a passive index fund, 8 cents goes to Nvidia, and then 92 cents goes to all the other plebs. So you see what this does. It's actually a feedback loop where the bigger Nvidia gets, the more of the passive inflows they get. Therefore, the bigger they get. And the bigger they get, the more the passive inflows that they receive from every single dollar that's going in. So you just have this self-perpetuating machine where whoever is at the top, in this case Nvidia, just becomes bigger and bigger and bigger and bigger and bigger, not because of discretionary buying, but more so out of just passive inflows and the way the S&P 500 works in the sense that it's a weighted index. So you can see where this goes horribly, horribly wrong, where we've been talking about just Nvidia, but it applies to pretty much the entire Mag 7. And when you look at the Mag 7, they are a massive percentage of the overall S&P 500, and a big reason is because of the AI bubble. So if the AI bubble deflates, it's not just going to impact those AI companies, it's going to take down the entire S&P 500. But don't just take my word on it. Let's get right back to this article, and we can see that the exact number is 34.5% of the S&P 500's market cap gains so far this year attributed to Nvidia alone, and that's according to Apollo chief economist Torsten Sloke. And just to be clear, this goes back to June. He says such a high concentration implies that if Nvidia continues to rise, then things are fine. But if it starts to decline, then the S&P 500 will be hit hard. Because the S&P 500 is weighted by market cap, even relatively minor wobbles from the behemoths like Nvidia, Apple, Microsoft, in other words, the AI bubble, can move the needle on the broad stock market index. And as retail investors increasingly load up on the S&P 500 index funds, because that's what smart investors do, that means exposure to Nvidia and the AI bubble for better or worse. But now let's think through how this applies to the broader economy. Because I'm sure a lot of you right now are thinking to yourself, okay, George, who cares? I don't own Nvidia. I don't own any shares. I don't own an S&P index fund. I have 100% of my net worth in my home equity and my car. That's it. So this is an entertaining video, but it doesn't really apply to me. That's where you are wrong. Let me show you what I'm referring to. The top 10% of Americans are propping up the economy. This is not George Gammon saying this. This is MarketWatch. Here's what will happen if they stop spending. And why would they stop spending? Oh, I don't know. If stocks go down, if the S&P 500 goes down, or if this AI bubble blows up. And this is a perfect picture right here of basically the U.S. economy. So look at this chart. The top 10% of Americans own 87% of stocks. So we have to step back and think about this, let's just call it a K-shaped recovery, since the cerveza sickness, since the government locked up everyone in a cage, destroyed supply chains, and distorted the economy, creating this horrible economic environment. But what we've had since then is the bottom half, or maybe the bottom 75% that don't own assets. As most of you know, it's felt like a recession to them because their purchasing power is decreasing. Their nominal wages aren't going up at the same rate as inflation. Therefore, it's harder and harder and harder to put food on the table, put a roof over their head, and their job security is turning into job insecurity. But the other part of that K going up, those are the people that own the assets. In this case, stocks. It's 10% of Americans. They're out there spending like drunken sailors. They're out there spending like there's no tomorrow. They're out there spending like they're the government. And all of that spending in aggregate total from the top 10% is what's propping up the economy and preventing us from going into a recession. But let's just think this through. So the reason we're not in recession right now is because the S&P 500
is at all-time highs, and the 10% of the people that own the S&P 500 are spending money like a drunken sailor. Aggregate demand up. Okay, I get it. But then wait a minute here, because the S&P 500 is at an all-time high because of the Mag 7, and the Mag 7 is at an all-time high because of AI, and AI, or those stocks, the narrative, that's at an all-time high. That's hitting a hysteria because Moody, the millennial, going back to step one, is only focusing on the balance sheet of AI University, meaning the market is only focusing on the balance sheet and what's likely, or what Nvidia tells us they're going to be receiving in revenue, and what OpenAI is telling us they're going to spend on the stuff that Nvidia makes. But the market hasn't yet hit that Biden moment where they're like, wait a minute here. How is OpenAI going to spend the trillions they need with Nvidia? Therefore, Nvidia should be trading at a $4 trillion market cap if OpenAI is only making $12 billion a year. And even if the adoption goes exponential, their revenues will likely go down because at the end of the day, they're just selling a commodity. You see how this is all interconnected, and this is why I'm making the claim that the current AI bubble is actually worse than the dot-com bubble, because going back then to the late 90s, early 2000s, the U.S. economy wasn't as dependent on these asset prices as it is right now in 2025.
Step number 3. So how on earth do you protect and hopefully grow your wealth in this type of environment with the bears, the bulls, and the bubbles? Well, the good news is it's actually pretty easy. All you have to do is the opposite of what everybody tells you to do. Let me show you exactly what I'm referring to. I'm going to give you an example of a stock that we've been talking about in Rebel Capitalist Pro, where we used these strategies, in other words, did the complete opposite of what everyone tells you to do, and we had a big winner. This one year to date is up 200%. Okay, so the first thing that the mainstream media tells you to do, and the financial planners like Dave Ramsey, is don't think whatever you do. Do not use your brain. Just take a portion of your paycheck every single month and put it into the S&P 500 index fund, just like a robot, like a brain-dead zombie. Well, what you need to do in these very dangerous times to achieve your financial objectives is actually think. Use your brain. It's called critical thinking. So do a little bit of homework. Do a little bit of research. Seek out mentorship from people, the professionals, that have been doing this successfully for decades. Absorb as much as you can. Come up with your own framework, your own ideas. Make sure that you're just basing those ideas on the fundamentals of investing, which are not, be it brain dead robot. That is not a fundamental of investing. So the next thing everyone tells you to do in the mainstream media and the financial planners is to buy overvalued stocks. Well, it doesn't matter what the valuation is. It doesn't matter what the risk reward is. You just have to buy whatever is in the S&P 500 because that's what smart investors do. Ironically, they say that's what smart investors do. I guess smart investors don't actually use their brain. You would think if they were smart, they would actually think about something before they did it. But what we have to do is look for undervalued companies. That's right. Instead of buying these high-flying AI stocks that are obviously in a massive bubble, now that doesn't mean that they can't quadruple from here, but let's just simply look at the risk reward. We have to buy undervalued companies. And let's just assume for a moment we do go into a recession. We have a stock market crash. Okay, fine. If we own undervalued companies, will they go down? Probably, most likely. but they'll go down a lot less than the bubble stocks like Nvidia. So the next thing you're told that you have to do, but you should actually do the opposite of, is buy and hold investing. It's not about timing the market. It's time in the market. Well, has this worked for the last few decades? Absolutely it has. But why? Because the valuations in the early 1980s, which is the charts that all the financial planners use, mysteriously, they don't use charts before the 1980s, as if the stock market didn't even exist. But they just go back to the early 1980s. Why? Because valuations back then were incredibly low. Incredibly low. Editor, go ahead and throw up a chart of the Buffett indicator. We'll just use that as a broad proxy for how cheap stocks were back then. But you can also look at the CAPE ratio. You can look at the trailing 12-month PE ratios, and it's all the exact same story. So if you're buying the S&P 500 when it's incredibly, wildly, historically cheap, then yeah, buy and hold investing, that's a smart thing to do. But right now, the stock market is the opposite of that. Instead of being wildly cheap, it's wildly expensive. So what we have to do right now, even with great companies like this, even if you can find them undervalued by actually thinking, is you have to buy, sometimes hold, but then sometimes you gotta fold. It's like that old Kenny Rogers song that we all know, I'm sure, extremely well. You gotta know when to hold 'em, know when to fold 'em, know when to walk away, know when to run. And right now, looking at the S&P 500, I wouldn't just walk away, I would run away. I had to throw that in there just to amuse myself. Okay, so let's go back to Rockhopper here. This is a chart of the year to date. So we go back January to September, October. On the left, we go from 20 bucks up to 90. Look at this chart. Now, I want to highlight that, yes, it has gone up by 200%, but if you look at the PE ratio, it's still right around 15. So think about how cheap it was back here. So if you would have just been the brain dead zombie and bought the S&P 500, well, you would have been up a whopping 13%. But if you actually would have used your brain, looked for mentorship, and if you actually would have bought undervalued things, then buy them and hold them, and at the correct time, go ahead and fold, in other words, sell, then you would have had a huge gain. In fact, you would have outdone the S&P 500 by right around 187% just year to date. But here's where it gets really interesting. Rockhopper is an oil and gas exploration company that was recommended by my good friend and business partner, Chris McIntosh, in our private investment community, Rebel Capitalist Pro. But Chris bought it back here, but he sold it right around here. And he realized this 200% gain. Now you may be asking yourself, why on earth would Chris McIntosh do such a thing? Because he found a better opportunity elsewhere. A stock where the risk reward made even better sense than Rockhopper trading at a 15 PE. Remember back here, when it was right around, let's just say 30 bucks, just think what the PE was. I don't know what it was that time, but it was a hell of a lot lower than 15. So this is just a great example, courtesy of my good friend Chris McIntosh, of a stock that wildly outperformed the S&P 500, but he was able to do that and recommend that to our members because he did the opposite of what the mainstream media and financial planners tell you to do. So the bad news is I think this AI bubble is definitely worse than the dot-com bubble, but the good news is there are things you can do right now to be proactive to make sure you're not only surviving whatever comes our way, but building wealth and thriving. If you'd like more information on Rebel Capitalist Pro, which is the online private investment community, I have my good friends Lynn Alden and of course Chris McIntosh, where we go over these types of contrarian strategies that could lead to these types of gains. We'll go ahead and put a link in the description below.